Hi, this is John Kumarianos with Mindful Advisory, bringing you a new edition of Driving Returns on this Labor Day weekend, 2024. Two articles up, two items up today. The first one is a Financial Times article by Jumana Saleheen, who is the chief economist and strategist at Vanguard Europe. And she makes a point that we made in our previous video when we cited that Richmond Fed paper. She thinks the neutral rate, the new neutral interest rate, is going to be between 3 and 3.5%. What does that mean? What does it mean when economists and Fed economists talk about the neutral rate? The neutral rate is supposedly a rate that neither stimulates nor constricts the economy in any way. And again, she estimates that going forward to be in the 3 to 3.5% range. That is a very big difference from the period from the end of the financial crisis up until COVID or through COVID lockdowns, let's say. What does that mean for investors? It means that bonds are likely to be more attractive than they have been in the past. Retirees, take note. You need income. Bonds are likely to give it to you now, whereas they haven't, or certainly hadn't in the 2009 through 2022 period. And she also says a number of times that stock valuations are stretched. So it's time to consider, especially if you're a retiree, I think, what your optimal allocation should be. Is it 60-40, which is kind of classic balanced, or is it more like 40-60 now that bonds are paying more and stock valuations are stretched? Consult with your advisor. Your optimal allocation might be different than what you think. The second article is from James Mackintosh, excellent writer at the Wall Street Journal, who goes through a series of um, AI ETFs, artificial intelligence ETFs. And he shows that many of them are invested in stocks that haven't done very well, despite the fact that NVIDIA and the what we call the mega cap tech stocks continue to do well, especially NVIDIA, Microsoft, stocks like that. But a lot of these ETFs don't invest in those big mega cap technology or artificial intelligence related stocks, and they have not done well. So be careful about what you're buying when you want to get exposure to some sector in the economy or to some economic trend. It's not as easy as you might think. And a lot of these funds, although I'm sure care is taken in putting them together, aren't guaranteed to get you exposure to the stocks that are likely to benefit from a certain economic trend. So those are the two articles this week, one from the FT, one from the Wall Street Journal. This is John Kumarianos for Mindful Advisory and for Driving Returns signing off. If you need to discuss asset allocation, financial planning, retirement planning, please give us a call at 201-951-3509. And the website is mindfuladvisory.com. Thanks very much.